always hosted this event at the Belmont Country Club and had a festive evening, but in the new world we're in, we're doing a version of this remote. Today, we're going to start with some of the potential tax implications of an election outcome, and that's what we're going to discuss first. There'll be another hour session after we finish up our local one here at Lexington, which we're going to be doing with our corporate partner, which is going to cover more of the big picture investment implications, and we'll talk a little bit more politics. We here at Lexington don't get into politics. The only reason we do is to get into what the possibilities are from a planning and tax perspective. So we thought it would be useful today if the likelihood of if Biden is elected and if there's a blue wave where all three branches are controlled by Democrats, a lot of the conversation we have today, there's a good chance it will be relevant, and there'll be an opportunity to do a fair amount of planning, possibly between now and year end, for people above a certain level. If Biden's elected and then if the Senate remains Republican, some of these issues may become less of a planning discussion. But we'll see which way the election goes. But we want to be prepared if there is a blue wave, and we want our clients to be prepared to potentially do some planning between now and year end. So what we decided to do today is we've invited several folks. We've invited Tom Goodwin. He's a partner at Goodwin Partners CPAs, and Tom's been a former Big Four partner, and he's been a great resource to us here at Lexington, and I think the world of his advice, and he's certainly seen a lot over the years. You probably see Tom there on the screen shaking his head. He's looking very handsome this morning. We also have Pam Pardoe, who's an attorney here in Lexington, and Pam has done quite a few events with us in the Empower Women series. She's backed by popular demand, and she will be covering largely the estate implications. She does family law and estate law. Beaming into our screen, you just saw our own Professor Glenn Frank. Glenn's been with us for several years. We're fortunate to have him. Glenn is a principal here at Lexington. He's a co-founder of the financial planning program at Bentley University. And for us, covers a lot of the tax implications in terms of how it relates to portfolios. And more recently, he's become empowered with his Time, Money, and Joy series. He's looking at beyond taxes. So he's no longer the squirrely tax guy. He is the squirrely tax guy. He's also the guy trying to help you look at life beyond your current situation. So we're going to start. I'm going to be the host today. And we've got several topics that may come up. So assuming there is Biden is elected president, and if the Senate does fall to Democrats, there's a good chance we could see a resizing of the tax structure and tax code. Now, keep in mind the conversation we're having today is based upon proposals pre-election. Even if there is a blue wave, what's talked about isn't necessarily what comes into legislation. So I don't want to be alarmist for those who are worrying about their tax implications, but I want to at least give everyone a heads up. And depending on which way the election goes, I do suggest that everyone sit down with their tax advisors, with their estate planning attorneys, as well as with their wealth advisors. And there may be an opportunity to do some planning between election day and year end. It certainly doesn't preclude planning after that, but we can discuss what the implications may be to doing planning in the first part of 2021. So I have my cheat sheet in front of me. We've got a series of issues, and I'm going to try to direct each issue to where I think it most appropriately goes, and then the other panelists can chime in and around that. The first one is income tax rates. So on the surface of it, we look at the proposed top rate is 37. The current tax rate top rate is 37%. And there's a proposal for it to move up to 39.6 for those making over $400,000. And on the surface of it, it looks rather benign, to be candid, right? But there's a couple of things that go along with that. It's 400,000 is the magic number that's getting thrown out there. That if you're below that, not to worry. I'm hearing some talk about potentially a rejiggering of the brackets, so people that are in different other brackets along the way may now creep into this bracket. A. B, there's some talk around tax deductions, and in terms of tax deductions being capped at a 28% rate along the way there. And then there's the small business piece which is small businesses get a tax preference right now, which may go away sooner rather than later. So I threw out a bunch to talk about there. I'm gonna throw it to you, Tom, to talk about tax rates on, I'm talking about ordinary income for now, and we can take it from there in a minute.
Okay. Yeah. No. As you said, Mike, the rate's going to go up to 39.6% in all likelihood if there is a blue wave, and that's one of the smaller pieces of the tax change. In that regard, earned income greater than $400,000 will be once again subject to the Social Security tax and self-employment tax if you're self-employed. So right now, the rate for 2021 was just announced. It's about $141,000. People pay self-employment tax up to that level, or they pay Social Security tax through their W-2. Starting next year, if the law changes, what the Democrats have been proposing is over $400,000. They'll reinstate those tax rates for compensation and other self-employment income. So a self-employed person could go from, the 39.6 to another 12.4%, which would be over 50% tax on the federal side. Plus
And have you pause there for 1 sec, Tom?
Sure.
You leapfrog the income, but we'll talk about payroll taxes. So this is the so-called donut hole tax, right? So right now, what's proposed is 12.4% on the first 137, then essentially no tax till you get to $400,000, and then it kicks in again at $400,000.
Correct.
So let's talk about what that has to do with organizational structure and some planning opportunities around that.
Okay. Yeah, I mean, that will open up S-corps again being more popular, because traditionally S-corps, you have to pay a reasonable compensation to your shareholders, but beyond that, any additional income is not treated as self-employment income. So if somebody, for example, had an S-corp, had an LLC right now, or a Schedule C on their tax return making $600,000, you would only be paying self-employment tax on the first $140,000. It really wouldn't make much difference structure you're in for that purpose. But if the rules change and you're making that level, then it would make sense to have an S-corp that would cause you to have compensation only in the $150,000, $200,000 range, and then the rest of it would be income that would not be subject to self-employment tax. So you'd be able to pick up that 12.4% savings.
Okay. So I think we covered payroll taxes. Going back to ordinary income, the rate goes up a bit, but there's also a couple of double whammies with that. So QBI, which is a deduction small business owners gets, would go away. Is that correct?
That's correct.
And what's the tax advantage to that right now?
Well, right now, 20% of this qualified business income, subject to certain other limitations, is not taxed. So if somebody had a business making $1 million and meets the other tests, $200,000 of that income is not subject to tax. That could be real estate income. It could be a regular trade or business. So that can be a big number. So if that's going away, then you're going to have essentially 20% of your income that's now going to be taxed, which is sort of the equivalent of another 4 or 5% rate increase.
You don't see it? Do you see any planning opportunities around that, or is that pretty much?
There's no real planning opportunities in that regard, because your income is sort of where it's at. It may cause you to want to bunch income to the extent you can get under $400,000, 1 year, and then maybe defer income into a later year, stay under the $400,000, and then take extra in the following year when you're not going to be.
Well, that's potentially a planning issue probably for small business owners who have some more ability to maybe time income a little bit more than an employee working someplace.
Right. Yeah.
One other piece while I'm staying on this, Tom, we're going to rotate off you in a minute, but we're also talking about capping deductions. So if I'm in a 39% bracket and I go to deduct something on my Schedule A, there's talk of capping that off at 28%. So it's kind of a stealth tax that will slide in there. Can you?
Yeah, that's right. So if they pass that and put that in there, itemized deductions will only be worth 28% to the extent that you're offsetting income above $400,000. And there's some even talk about, maybe the 28% limit will apply even below that. But for now, it's primarily focused over $400,000. So the key, again, from a planning standpoint, is by the end of this year, we've already, with the state limitation that was put in before of $10,000, a lot of taxpayers bunch their charitable contributions to be able to maximize. This would certainly be a year to accelerate, charitable contributions and the like, and bunch multiple years, even using a charitable, like a Fidelity or, one of those
Donor advised funds, sure.
Donor advised funds.
So I want to pause there for a second. So we're talking about the income side. So I'm going to make a statement, then I'm going to turn it over to Glenn for a moment. And Tom, you feel free to disagree with my statement. So if we see these things come to pass, or we think there's a strong chance this will get passed with a new administration if there is this blue wave, it seems to me that this could be an unusual year in that you would attempt to accelerate income and also accelerate deductions in 2020. First, do you agree with that assessment? And if you do,
Yes.
Okay, you do. So now, Glenn, I'm going to turn it over to you. And can we talk about opportunities from a wealth management perspective? I mean, Roth conversions and the like, some things that we may do, or maybe even booking some gains that we usually would defer.
Yeah, no, happy to, Mike. So if I can start either place, we start with booking gains. So obviously you don't want the tax tail to wag the dog, but it's still an important part of the pooch's anatomy, I guess. So it's always been kind of three choices. Maybe I can almost give you a Monty Hall, let's make a deal thing. Sure. So you've got low basis positions in your portfolio, and the three choices are: do I sell, do I keep, or do I give away? So let's go through those three choices with the backdrop of new tax laws and the implications for a minute. So let me give you a really simple example. Let's say you bought XYZ stock for $1,000, and now it's run up to $11,000. Okay, so that's a very convenient $10,000 gain. And maybe somewhere along the lines, you heard the rule of buy low, sell high, and you think it's time to sell, but you're thinking it through, and what are the tax ramifications, et cetera. So behind the door number one is I sell it. And I'm willing to incur the $2,800 in taxes. That's the maximum cap gains rate right now. And so if you're somebody over the $1 million threshold, next year it might be higher than the 28%. It might be 39.6. So if you're somebody with that very high level of income, and the Biden proposal actually goes through, then your cap gains rate might be higher next year. So it might be less pain to just cut the check now. Okay, so, and you also might think through that if I sell it, look, sooner or later, I've got a cap gains tax anyway. And I think Pam is going to chime in on step up in basis in a bit. But yeah, basically pay the tax now I have the gain is a consideration. Now, that's the first door. The second door is I keep it. And I love the stock. It's run up. It may run up further. And whatever I put my investment into, God knows if it's going to do better than XYZ stock. And cutting that check in April is pretty painful. And again, maybe I never was going to pay the taxes anyway. We never have a step up in basis change. I don't know. So door number three, to give it away. So you can give it to family. And you may find family members who are in a no or very low cap gains rate tax. So you might think through that. Obviously, there's implications about giving money to family members. Or you might give it to charity. And we mentioned donor advised funds, et cetera. And you got a clever CPA like Tom who figures out some bunching for you. And this may be the prime year to do it. I mean, for a lot of positions, valuations are quite high. And if you gift it away, let's go through the math a little bit. I got $11,000 stock, And let's say that this year, maybe I'm in the top bracket at 37%. Maybe you got a deduction for 11,000 times 37%. Maybe that's $4,000. And I avoid the $2,800 in cap gains tax I would have paid. Basically, almost half or even more than half is tax savings. And with the donor advised fund, you can decide when to give it away later. Maybe because the kids aren't going to get that money, maybe get them involved in what charity it goes to. And God knows the charities could use the money right now. So that might be a really tremendous move. How you decide the three doors is very dependent upon your financial situation. We have this concept that we continue to cover called what's your number? So there's a dollar amount we all have that where work is optional. If I'll make up a number. Let's say the number is $2 million. I know if I have more than $2 million, my lifestyle is covered. If I have less, I don't. So if you know that number, you can make these decisions about whether or not you can afford to let the stock run, whether or not you can afford to give it away, et cetera, et cetera. So I blather on, as Mike well knows. But the cap gains piece is now we have these new twists. The rates might be lower now. I mean, there's deficit pressure, and then sooner or later taxes are probably going to go up. And there's another subtlety. When people do their net worth calculations, people conveniently omit built-in tax liabilities. I think it's good to put it in there. It reminds them that it's a sooner or later proposition in most cases.
Glenn, I'm going to pause you for 1 sec. So this is really good. Thank you. So this year specifically, if there is a blue wave, and if we think there's some possibility that what we've outlined here is going to take place in next year. So we may advocate looking at booking some gains earlier than later. We may talk about doing Roth conversions, accelerating income, and potentially maybe grouping some more charitable deductions for multiple years to accelerate and get the full value of the deduction versus being capped at 28%. First, Tom, do you agree with looking at those as proposals?
Yes. Yeah, I mean, it's a good time to do it, assuming the blue wave comes in, because and some of the other changes that you're going to be talking about over the next few minutes, all of them come together in kind of a tsunami that advocates, making some different decisions than we've made in the past.
Sure, Glenn, and any caveats on that, Glenn, from your perspective?
No, I agree. I was going to elaborate a little bit on Roth conversions as a particular opportunity this year. Kind of base level thinking on Roth conversions in general are, what's my tax rate now versus what my tax rate would have started to be at age 72 when I have required minimum distributions. And the math says if it's about the same rate, it doesn't matter, it's a wash. Okay, but there's a subtlety. People think, well, rates are going up, so I should do it now. Rates may well go up, but your taxable income may be a lot less because you're no longer working. So you have to think through what my rate is now. If you're still working, your taxable income's higher. So again, you have to make an apples to apples comparison of what your rate now is versus what it's likely to be in those retirement years.
Excellent. Thanks, Glenn. That's an excellent point, and that's what we try to do at Lexington here in conjunction with CPAs. And we'll try to look into the future and using current rates, whatever they may be, and try to do some sort of projection. Pam, I'm going to turn it over some questions. I want you to lead the way with us here. There's they're looking at some pretty significant estate and gift tax exemption. As it stands today, a couple can have up to $23.16 million. And from a federal perspective, we'll say federal for now to keep it apples to apples, there's no estate ramifications from a tax perspective, right? It's 11.5 and change per spouse. What we're hearing proposed is anywhere from $1 to $5 million per spouse. So that gives you a $2 to $10 million range. And after that, federal estate taxes kick in. That seems pretty, dramatic to some. So I know there's families of all kinds of different net worth. We've got families worth a few $1 million. We've got families worth hundreds of millions of dollars. But I wanted you to give your take at that and what some possible planning is, and between now and year end, or between year end and early next year.
Thank you. Yeah, that will be a significant change, and I think it will lead to significant estate planning opportunities. When the estate tax rate went up to $20 million plus, a lot of people just didn't have to concern themselves with it anymore. And that may not be the case. When that rate drops to $5 million per person, so that maybe $10 million as a couple or lower, a lot of these people who didn't have to concern themselves with it will suddenly be faced with the very possibility and likelihood of paying significant estate taxes from the federal standpoint. And there's a lot of planning opportunities, some we haven't looked at in quite some time, that I think will begin to become more relevant and potentially being able to take advantage of those opportunities. Those are things like qualified resident QPERTs, qualified personal residence trusts, where you give away parts of your entire residence and maintain the ability to stay in it, but it, for federal tax purposes, gets that property out of your estate. There's charitable vehicles that allow for, again, people to get the money out of their estate for estate tax purposes, yet retain an interest in those vehicles, in that money. And so it can be used as an annuity in the future. And there's several ways to structure that. So there's a lot of these advanced planning techniques that I think will become much more popular if the federal estate tax rate is lowered.
So Pam, I'm going to take it back to a very basic level. You have a family currently, say, worth $20 million, and they've got 2 or 3 kids. So you'd say, well, under the current law, there's not, there's $23 million exempt from federal taxes. There's something that I'm surprised a lot of people don't realize is they can actually use part of that credit during the lifetime. If they want to give some of that money to their children, they have the ability to do so, right? And utilize part of that credit.
Yes.
There's beyond the financial side of it, there's an emotional, family, a heart, if you will, matter. How much is the appropriate amount to give and when, and so on and so forth. But I'm going to stay with just the math at this particular point. If someone did have that kind of worth, and if there were a blue wave, I've talked to several attorneys about this. Several are beginning to do planning to maybe move that to their heirs prior to year end, is what some have told me is absolutely safe. The other piece, I'm going to throw it out here, and it's a continuum. If elected and there's a blue wave and legislation is put into effect, say next June, some attorneys think you may have the opportunity to do this planning in January, February, March, April, May, because it will be rolled forward. Some people think it may roll back to January 1st. I guess I'm going to throw it to you and to Tom. What's been your experience when legislation changes some point in the year with respect to, there's income taxes, there's capital gains, and then there's estate ramifications. So any thoughts from either of you on that?
Well, from an estate tax standpoint, generally, when the law goes into effect, that's when the rule applies. It's not an absolute by any means, but historically, you hear the talk of a new law, the planning for it, the passage of it, and then it effectively is effective from the date that the bill is signed. But there's a caveat, which is that until the bill and these plans go before Congress and is discussed, we really don't have any hardcore evidence to suggest that they would not make that retroactive to the date that the bill was first put into session, or even before that. So if you're going to go by historical measures from the estate planning aspect of it, not the tax aspect of it, then I think there's some security in believing that there's some time to do the planning and the drafting and the execution of these documents, which oftentimes can take time for advanced planning to make sure that they are done properly. But if you have a concern and you want to get this done before any potential changes in the law, then in case it does go retroactively, then you need to start planning and speaking with your estate planning professionals, your financial representatives, and your accountants and tax planners really very, very quickly.
Excellent. Tom, any follow-up comments to that?
No, I would agree with that. On the income tax side, while it's generally not retroactive, things like capital gains will probably be changed effective as of the date the law changes. But the income side is often, oftentimes use a blended rate. It's awfully difficult to go ahead and make changes with respect to income as of a particular date during the year. So some of the things that are proposed that we've talked about and a couple of other things we haven't even gotten to yet will most likely have a blended rate for 2021 that will average based on the time of year it goes in. If it goes in July 1st, it may be half of the increase for the first year.
Mm-hmm.
But things like the estate tax will probably be something that would be effective as of the date the law changed.
Excellent. I'm going to turn it over to you, Glenn, 1 second and try to give us like a 2-minute response, because we're going to cover a few more things before we end. But there's shades of gray here, right? If a family's worth $7, $8 million, $9 million, and they think they may need that money during the rest of their lifetime, and they're not ready to carve it out to the kids yet, or for other purposes. And then, and maybe even a family with $15 million isn't ready to do so. Then can you talk about that briefly and just talk about the concept of financial floor briefly?
Yeah, no, it's funny, Mike. You're gonna cut me off at 2 minutes. I understand. You know me well, buddy. Okay, sorry, I already used up 30 seconds. Funny. So yeah, no, it's a domino effect. So A, how much money do the parents need to secure their lifestyle? B, how much money do the kids need to secure theirs? And if they have enough in assets for A and B, then gifting becomes a possibility. And so until you go through the math and understand that, it's very difficult to really draw conclusions. And then, of course, there's the emotional aspects of it. I had one quote from a client years ago. He said, I want my kids to have enough money that they can do anything they want, but not so much money they don't want to do anything at all. So that's a real conundrum. And I'm sure Pam can attest to this. People get stuck at that. I know how much I need. I don't know how much I want to give to my kids. And then they kick the can down the road, and then sadly, the matriarch are gone, and the kids have a big chunk of money, and they don't know what to do with it. And I can go on and on. So my 2 minutes are up. Okay.
Thank you. That was good, Glenn. That was an iteration, and that's a lot of what we do here at Lexington, is really have deep conversations with people to really get into what they're concerned about and trying to play chess, I guess, not checkers, right? Next piece is something that's it's subtle, but I want to throw it out, and I know you've all got opinions. There's something called, I'll do a quick explanation of a step-up in basis on death. So I buy a stock for $100,000. It's now worth $2 million, right? And I'm 92 years old, right? And so maybe I know I should diversify, but I don't want to sell it now and pay taxes on it, and my estate gets lowered. So I may hold on to that stock. And so when I pass and my kids get that stock, they get a step up in basis. So it's as if they bought it for $2 million, right? And so if they sell it, no gain. There's talk of step up in basis going away under this Biden plan. I guess comments, I'll start with Tom first, then shoot over to Pam, and then if Glenn has anything you'd like to chime in, take it from there.
Okay. Yeah, that's one of the more significant issues or items in this whole plan. I mean, others are just money raisers, but we talked about earlier about making gifts before year end. Historically, we've always worked with our clients to plan to hold assets, the type that Mike had talked about, the Apple stock they bought pre-public, or some real estate they've owned since the family's owned since the 50s or the 60s. Hold that till death, and there won't be any income tax. I have one particular client that's been a whole linchpin of his plan of holding a piece of family real estate. And now if they do away with that, they're talking about only doing away over $400,000, but for the meaningful numbers, this is going to be a very large issue. So some of the planning prior to year end, you need to be a little careful as to what we give away and what we wait to see if this happens. I mean, my personal opinion, they've tried this before, and I suspect that they will reinstate they will take out that provision probably in exchange for, some rate differential on the estate and be some sort of trade-off, because it's going to be very difficult to track that basis 50 or 60 years.
Okay, fair. Pam, would you like to chime in anything on that particular subject that Tom didn't cover?
I think this is a huge issue. The ramifications are really outstanding if, in fact, the step-up in basis disappears. I think from a planning perspective and from an estate administration perspective, we generally advise our clients to just hold on to things that have appreciated in value. They might want to sell their house to move into a retirement home, but if they do that, they're going to have significant tax consequences for that. And if they don't sell their house, if they can find a way to maintain it that they've had for 20 or 30 years that has this appreciation, then their heirs or their devisees will take that property with a market value on the date of death. So that appreciation effectively just disappears. And that's the value that we're talking about. And even with a $400,000 baseline, so many estates are going to be impacted by this rule. It certainly will, I think, bring a lot of tax dollars to the federal government, which obviously is why they're discussing it and proposing it. But it will have a tremendous impact on planning. And I think from a financial perspective, as well as from an estate planning perspective, I think it will bring in a lot of insurance trusts and irrevocable trusts that we just haven't really used as part of our planning. Will become much more relevant. The items, the planning tools that I referenced earlier, the qualified personal residence trust, the charitable remainder unit trust, and the charitable remainder annuity trust will, I think, become more prevalent. And this is so that the asset gets out of the estate, that the appreciation, especially with the charitable trusts, they've got some really, I think, interesting and unique planning opportunities where you can take advantage of some tax savings with those. And I think those tools will really become just a part of many, many estate plans in the future that they just don't, are not even considering those now.
Excellent. I'm not going to go to you, Glenn, on this one because I have one more issue I'd like to cover. But what I'm seeing here is I think we should all get a lot of sleep now because we could be pretty busy come mid-November going forward. There's many other pieces to cover, but probably the last big issue I wanted to cover before I make a closing comment is capital gains rates currently, for the most part, are at 20% federally. There's some exceptions with lower, but 20% federally. There's talk of making capital gains the same rate as ordinary income for top earners, and that's 39.6%. For anything over $1 million. So I'll give an example, and please correct me, Tom, if I'm wrong. I make $800,000 and I sell a stock and I make $1 million of profit on it. So I go from 800,000 plus the $1 million, I'm at 1.8. My understanding on this one is that to the extent the capital gain is anything over that $1 million mark, instead of getting taxed at 20%, is taxed at that new rate, which would be the 39.6. First, do I have my facts right?
Yes, you do. Yeah. Okay.
So that's a little scary, right? So I guess I want to talk about that and talk about what some potential planning opportunities around that. I mean, other than if you have items that to sell prior to potentially year end or the first part of next year, if you want to take a little bit more risk and on the legislation. What might you do to help mitigate some of that extra cost? That's a big deal, right? To go from essentially 20% tax to 40% plus the 3.8% Obamacare tax. That's a big chunk out of your gain.
That's right.
What do you see
Well,
any?
I mean,
I've got some thoughts on planning.
selling this year. I mean, going forward, trying to manage the numbers so that you stay under the $1 million. If it's a piece of property, maybe doing an installment sale, maybe making a charitable gift to bring your income below $1 million in a given year to keep the gain from being taxed. Again, a donor advised fund to put some of the put some of the assets you might otherwise be selling into that to to manage that that income. I mean, that also extends, by the way, to dividends that are now taxed at a top rate of 20%. So, tax the wealthy side of the taxpayers, the top 1% or so, probably have $1 million or more dividends, in their portfolio, and that would then push it up to, that would be taxed at a double the rate it's currently taxed.
Sure. I'm going to toggle over to Glenn. Glenn, comments from a wealth management perspective. What might we do from a planning perspective here?
Yeah, no, I agree with Tom. So it's kind of that door number 3, give it away kind of thing, whether it's charity or maybe family members who are well under the $1 million. And the family could effectively pay lower taxes. Certainly would be something to consider if it's practical. Yeah, though that's really the key point I'd like to make, Mike, is
Sure.
to navigate that and again, don't let the tax tail wag the dog too mightily.
How about from an investment perspective, using, we utilize some firms that really help mitigate tax costs, like Pardoe, for example. Could you discuss that briefly?
Yeah, so I don't know if people are familiar with firms like Pardoe. It's really cool. It's people love index funds and they hate them. They love them because you're broadly diversified, they're low cost, and they hate them because you can't do anything tailored. You're just pooled in like any other fund with a bunch of other investors. So the best of both worlds are these separately managed accounts that are run like index funds. So basically, you can migrate in all these low basis positions and complement them, work around them. So if you're in one particular sector and it's all low basis, they avoid that sector. So it's your own separately managed account, but it's kind of a targeted index-like returns. And so the beauty of that is during the year, they can harvest losses and just replace anything that went down in value with something similar.
Sure.
You can pull off.
I'm getting the high sign. So in that regard, we use a few firms that do that kind of strategy for our clients. Pardoe and another firm called Parametric are 2 firms that we like a lot in that area. Yeah,
the whole concept has been around for probably 20 years, but a lot of people aren't aware of it. But it really works beautifully from an estate income tax perspective, et cetera. I mean, repaying positions get step up in basis, they're gifters. Even though it costs a bit more than an actual index fund, all the tax advantages mitigate those costs typically.
Sure. I'm going to pause for a moment. I'm going to sign off in 1 second. So keep one thing in mind. So this is these taxes are largely directed at affluent people, but there's a lot of other things that are in the program to help more middle class people. There's child credit, dependent care credit, first-time home buyers credit, caregiver credit, and ultimately potentially funding more social programs and the like. So we're making no political comments here at Lexington. We're just trying to help navigate as best we can for our clients. And the way we navigate is working closely with the client and their family and working with their tax advisors and their estate planning attorneys like Tom and Pam. So we're very thankful for all of you for your time today. This is the pregame show to the main event, which is happening in a few minutes, where we partner with our partner firm Hightower, and we're putting on an event that's going to talk more about the implications of investing with various administrations, and someone's going to speak to the politics of how things are going right now in the polls and so on and so forth. So I hope you all enjoy this. I know it's a little bit of a dry topic, even though we're all excited and animated about it. Most normal people don't love this sort of thing, but keep in mind that I really believe that all of you may need to look at doing some planning and accelerated planning, depending on which way the election goes. So thank you for joining us here today at Lexington, and we hope
Thank you very much for having me.
Well, thank you, Pam.
Thanks, Mike. So you're saying